Obviously, I too was surprised by the big jobs number. It tells me that so far we're not seeing much of an imprint of our tightening to date on the labor market. There's some evidence that it's having some effect, but it's pretty muted so far. So I haven't seen anything yet to lower my rate path, but I'm obviously keeping my eyes open, and we'll see how the data comes in. But right now, I'm still at around 5.4%. If I had to pick a number today, I'd be where I was in December.
Are you feeling good about being at that place and thinking we need to put more restraint on the economy, that much restraint, even though your colleagues are a little lower?
I mean, that doesn't make me feel good. Right? I wish we saw more evidence that underlying inflation was trending the way we wanted. We have seen, obviously, headline is down, core is down, but if you strip it all apart, the services side of the economy is still very robust, and wages are still growing at a rate that's in excess of being consistent with our 2% inflation target. So we have to bring the labor market into balance. I'm not sure if we've done enough yet. I think 5.4 may be the right number, but we'll have to see.
But Neel, I think maybe that's the key, is that you were already a little more hawkish on this. This may not have come as a huge surprise to you. Do you think it surprises your colleagues on the FOMC? Well,
it did surprise me. I mean, I certainly was not expecting a 500,000 job print for January. So I think it surprised all of us. Nobody should overreact to one report. Reports sometimes are hot, sometimes they're cold. But the underlying strength of the services sector of the economy is still very robust. And that's where I think a lot of us are focusing our attention.
I was just going to ask on the jobs front, what does the unemployment figure have to look like, do you think, as it relates to inflation, to claim some semblance of success? So when you see this sort of huge jobs number, is it possible that jobs could be increasing and the inflation number could actually come down at the pace you'd like? Is that even a plausible? Would physics allow this to happen?
It's hard to imagine that you're going to see very strong job growth while wage growth is moderating. And that's what I'm looking for, right? We need to see wage growth at around 3% to be consistent with our 2% inflation target and 1% productivity growth. Wage growth has come down somewhat, but depending on your measure, it's still 4, 4.5, even 5 on a 12-month basis. And so the job market and the services and wages are still very robust.
But inflation has been coming down. That's the thing. It's like you guys are raising rates. Job markets remain strong. But if you look at things like a lot of people are focused on in fact, one of your colleagues, Vice Chair Lael Brainerd, is focused on 3-month and 6-month annualized inflation rates, and they have been declining. How can you say there's been no progress when, in fact, those numbers are declining?
Well, that's good news, and it's better than them climbing. But the 3-month numbers tend to be quite volatile. And so, we can all pick a number at any given time that tells us the story that makes us feel better or worse about the outlook. We need to be disciplined. And so the most disciplined way is to pick a number in advance and then stick with it, that's our focus. And so we've said 12-month PCE inflation is our ultimate goal, total inflation, not just core inflation. But then we look at these other measures as giving us an indicator of where inflation is likely headed. The chairman did a really nice job in the press conference talking about this, that we go from total inflation to core, then take out core goods. You've got core services inflation. You take out housing because we can analyze that. Core services ex housing, that's a big part of the economy. We've seen no progress so far, virtually no progress in core services ex housing, and that's very tied to the labor market. And so we slice this all different ways to try to give us information about where inflation is headed. I'm not seeing that we've made enough progress yet to declare victory.
It's a good problem to have, obviously. Everybody knows that, low unemployment. So everybody was, holed up during the pandemic. So services are strong. People want to get out. They're flying. They're going to hotels. We understand that. They had stimulus money. That's eventually going to run out. That pent-up demand for vacations, eventually that's going to wane a little. You've still got a low participation rate. People are going to come back to the workforce. There's plenty of people available because of the participation rate. You're not going to have to pay them 5, 10% more. When the stimulus, when it finally runs out, when the demand wanes a little bit for going on that vacation, it should all moderate. I think a little patience would be fine. And the markets don't believe your 5.4%. Why are they so stubbornly resistant to 2-year to believing that we're going to get anywhere near there?
Well, I'd say a couple things, Joe. First of all, you just made the case for transitory. And that's probably where I was in, that a lot of this stuff is going to fade on its own.
I think we need to bring that word back. Because it's not the 70s or 80s. It's a pandemic reopening.
It's not the 70s or 80s, in part because the nature of the shocks were different, in part because the Federal Reserve's response was so different, and we've worked so hard to keep inflation expectations anchored. We are seeing more people start to trickle back into the labor force. I hope that continues to pick up. But if you look at the difference between market estimates of the federal funds rate path and, let's say, my estimate, for example, markets are much more confident that inflation is going to fall quickly over the course of this year. I hope they're right. I'm not trying to convince them that of a different inflation path. If they are right, we will take that information on board, and that will then go into our rate path. But so far, I'm a little more cautious. When I look at the wage growth and I look at the jobs report, I'm a little more cautious that inflation may not fall as quickly as markets are expecting.
So the hawkish conviction you have might be, hopefully, is transitory.
But
we'll see the data.
It's not quite that easy, right? That you can both have different attitudes because you guys rely upon the markets in order to affect your policy or have your policy have any effect. What is the concern right now? Do you have any concern right now that you have not seen the reaction in the markets? You've not had the financial conditions tightening. Does it cause you or does it create a need for you to lean further on the policy rate?
On the margin, it does cause concern for me individually. I don't think it's a good thing that mortgage rates have backed up. That come back down. I don't think it's a good thing. The Wall Street Journal yesterday had a report that the housing market is starting to show signs of life again because mortgage rates have come back down. You're right. It does make our jobs harder to bring the economy into balance. And all things being equal, that means we would then have to do more with our other tools if financial markets have a lot of optimism that inflation is going to fall more quickly. It is a channel by which monetary policy affects the economy.
So what are those tools? Those tools are raising rates more than you otherwise would?
On the margin, if conditions are easier, then that would cause me to say we would need to do more with the federal funds rate, and we also have the balance sheet as well.
Well, that's my next question is the balance sheet. Would you do more with the balance sheet?
I mean, there's more that one could do. I think the bar to switching, changing around our balance sheet path is quite high. It's not something there's active deliberations on, but it's always there if we needed to.
I was going to ask a question about tonight, which is the president's going to be speaking. Two things. One, and we were talking about during the commercial break, do you think they share their speeches in advance? And secondarily, do you think that there's a conundrum? And I'm curious if you will agree with the president tonight. I imagine that Powell's going to say, good economy, but too hot, and worried about inflation. And I assume that Biden will say, fabulous economy with maybe a wrinkle on inflation. And who will be more accurate about all of this?
Well, the president and Chair Powell have different jobs, and so they're both going to be. I imagine they'll both be accurate for what their mandates are and what their jobs are.
You think their mandates are totally different?
Absolutely, I think their mandates are totally different.
So you think the president could say this is a fabulous economy, and the Fed could think it may be less of a fabulous economy?
I think the president is responsible to voters. Presidents make promises to their voters on what they want to deliver. The Fed has a different mandate that's established by Congress, and that's where we focus our energy.
Why do you think where do you think the workers were who came back in to the workforce this time around? What do you think caused that? We were talking about the higher participation rate. Why is that? I've
been asking this question for 2 years. Where are the workers? We know a lot of people retired early because of the pandemic. Retirement tends to be a sticky state, but it's not perfectly sticky. Maybe you have retirees coming back part-time, which is great. They're going to be contributing to the economy, but I don't know. It's childcare, it's healthcare, it's a lot. There's no one story.
A recent paper that talked about the idea that real estate values sent people out of the workforce. Right. At the surgeon. But Neel, let me ask you this question. The same question I asked Chair Powell at the press conference. It basically boils down to this. What if you're wrong? You've had, by the way, a recent history, not you guys.
Me too.
You two, of being wrong. You were all on team transitory, and it turned out to be not quite so much transitory, even though some of it may be transitory. And now you're all like, inflation's not coming down. We need to go to 5, come hell or high water, pretty much. What have you guys changed about how you do your business such that now I can believe, oh, you got it right this time? Well, give me some confidence here because there's a lot of reason not to have confidence.
I would say I learned over the past year or two that our models that we use to rely on forecasting inflation really failed in understanding the dynamics of reopening from the pandemic. And then that just told me we have a job to do. We know that raising rates can put a lid on inflation. We need to raise rates aggressively to put a ceiling on inflation, then let monetary policy work its way through the economy, and we can always back off. So we're having to let inflation guide policy rather than our models guide policy. And that's challenging. It's challenging because there are lags that you're well aware of. But the most important thing that people should take away from this is we're totally committed to getting inflation back down to 2%. Not 2.5, not 3. Get it back down to 2%. And we're going to get that done. Now, is it going to take 2 years? Is it going to take a little longer? I'm not exactly sure, but we're going to get it done.
But are you nimble? We asked a question on our Fed survey that said, is the Fed data dependent or are they going to 5 no matter what? And it was pretty much divided. A lot of people think that you're not really watching the data, that you're headed to 5 no matter what, which is kind of like saying, you know, we're driving the car again into a brick wall, perhaps.
Yeah, I don't agree with that at all. I mean, look at the job report that we've just been talking about. I mean, these are things that we pay a lot of attention to. We pay a lot of attention to short-term moves in inflation, to services inflation, all of this. And we're pretty close to 5 now. It's not like you're not like saying, oh, come hell or high water, we're going to 10. We're at this point, we're debating.
You shouldn't have
about
said that.
A few more data points.
Neel,
exactly.
Neel, can I ask one more thing? So let's say that we have permanently higher oil prices for whatever reason, because it's, you know, we're transitioning away from fossil fuels. You got Ukraine, you got China reopening. So you got, let's say, permanently higher oil prices, which filter through to a permanently higher inflation rate, most likely. So you're going to force 2% on us. That's no matter, come hell or high water, the only way to deal with oil prices is to hurt demand, is to slow demand in the global economy. So we just have to assume we're going to, we got to grow slower. Oil prices are so much. The only way we can bring prices down is the demand side. That just seems like a bad way to approach things, to permanently accept lower economic activity just to keep inflation low because you can't control oil prices with supply. Or do you try to address the supply side?
Well, the monetary policy is not going to determine what the output is. I mean, if we said, after we get through this inflation period, if we all came together with Congress and said, hey, the target should be 3%, that's not really going to change anything. The size of the economy, the output of the economy, it's going to be smaller if the inputs end up just costing a lot more. We can end up achieving whatever our inflation target is by just running monetary policy slightly differently. I don't actually think that would have the damaging effect that you're talking about.
One quick piece of data, since so much of this economy seems to be supported by what seems like a healthy consumer, the question is how healthy you think the consumer really is, given the amount of debt we're seeing being put on credit cards, and also bankers. We keep talking to CEOs of banks who say, come this June, come this July, actually, like, the money is going to start to run out, really.
Well, we're looking at all of that. We look at it by income tranche, how much excess savings they had relative. There is evidence that lower-income Americans are paying down their excess savings. That might be a motivator to Becky's question, why people are coming back to work. That's probably one of the factors that's coming in here. And so it's something we pay a lot of attention to.